G'day guys, Josh here. Hope you guys are having a great day today. It's been a long time since I've done a lacking financial education piece. And, it's been probably like 3 or 4 months actually. But something came up in the news, okay? Or not in the news, in some of my advertisements. I got some advertisements in Facebook and from other people as well. So pretty much what happened was that someone was getting advertisements where they could use their tax money to repay their loan sooner. And I want to take a deep dive in on what it is. Now, for all intents and purposes, I don't want to, harass the person providing this or anything like that whatsoever, but a lot of people can probably easily find out who they are with a cursory search. I do not endorse any of that at all. I just really want to go through their ideas and strategies and why it isn't for most people. And even though they may say it is good for them, it really isn't. Now, first of all, so the strategy or explainer video that they provide to you is about buying an investment property. And they also say buy an investment property in a middle-ish area or a middle-ish house and make sure you have some cash reserves and cash buffer for bad times. And they basically say since since you've rented a property, it'll naturally grow capital gain wise and you get income from it, and then you can use that money to repay your mortgage while keeping your investment property loan as high as you can, so the interest on that is tax deductible. That is essentially the strategy that is, in essence, what they're trying to provide. Now, the upside of that strategy in particular is that, especially for high income earners, is that you're able to effectively borrow at a cheaper rate. So effectively, let's say, for example, you're on the top tax bracket in Australia, which is 47%. You can get most of that interest back as a tax deduction. So you're effectively borrowing at 3.5% rather than 3.5%. So estimate, okay, it's not a full out figure, rather than the full 7%, while repaying a mortgage, which is at a 6% or 6.5, but obviously at a, you can't tax deduct your mortgage either in Australia. So either way, you're 3% ahead. And that's the strategy that they're going for at the moment, to use your 3% extra, your tax dollars, to repay the loan. Now, this seems fine in essence, but the hardest part is these risks in particular with gearing. So property doesn't naturally just go up. Okay, like it can go up and down, up and down. In fact, you saw it before COVID and after COVID, and after COVID just went absolutely bonkers. But it doesn't go up over time. And in fact, sometimes you're going to have to sell when the market gets tough. And that's when interest rates increase over time. Now, if you're not on a good income, or in fact, you're unable to service your loan at any point, including the mortgage or the investment property, you may have to sell before you really want to sell. Okay, that's one thing. And also at the same time, with investment properties, if your property is untenanted, you can't claim that tax deduction because you are not generating income from it. Now, a lot of these people will say, oh no, you can still claim the tax deduction. But no, if you don't have a person in that property or any lease agreement signed, you cannot claim a tax deduction on it because you are not generating any income. Not to mention as well, if you're renting it to anyone and you're giving a mate's rates or anything like that, you can't claim a tax deduction, okay? Because it's you have to do it at market price. If it's not genuinely used to generate a market return, you cannot claim a tax deduction on it. So that's a few things you'll watch out for. Especially the big risk is when it's untenanted, or if you lose your job, or you're unable to work, which is 3 big things that do happen when you're gearing in particular. Now, a lot of these people also try to sugarcoat this strategy, saying that, this person retired at 30 because of what they did with investment properties and stuff like that. They could have retired at 30 because of the fact they were earning such a huge salary that they probably could do that at the end of the day. The best thing is that none of your assets that you have at the moment are primary income producers compared to one person, you, okay? So you are probably your own biggest income earner, so you need to protect that. Now, with these gearing strategies as well, these sorts of people don't recommend to get into any insurance or income protection or anything like that. The main reason why is a lot of these people aren't financial advisors or not AFSLs to begin with. In fact, I took a look at one in particular, and they did not have an AFSL at all. And you'd be thinking, wait, how can they give financial advice or tax advice then? Well, they can give tax advice purely because of the fact that you don't need actually an AFSL to provide advice in regards to property. So that's why they sell the investment property dream. And then what they usually do is they hide behind a general advice line saying that we're only providing a general advice in nature, when they talk about tax deductibility, because that is general advice. They won't go into the intricacies that you have to have a tenant in there, and it also has to be at market rate, because that's financial advice, and they can't hide behind it. So they just be as vague as they can with the details, so they can slip behind and not be giving advice to you. Now you are thinking, how the hell did they get the money from this? Like, how did they get any sort of money out of this? Now, first of all, they either, in the explainer video, they say, do you want to set this up? Or we can set this up for you. And if you go down the we can set this up for you option, they charge you an appointment fee. And they charge you, per hour appointment fee. And also they charge a big management fee up front for handling it on your behalf. Now, a second thing as well is that they organize the mortgage broker, okay? And basically when they refer you to the mortgage broker or anything like that, or to the mortgage, anything like that, that's actually not financial advice either, by the way. They get a kickback, okay? Advisors used to get a kickback previously from mortgage brokers as a referral. There was like a percentage fee here and there and stuff like that based on the interest rate. That doesn't happen anymore, and now the banks get to keep it anyway. So what happens is that this individual, or this group in particular, they are not an AFSL, so they're not affected by the same legislation that advisors are, where they can't accept that remuneration and have to refund it back to the person that they are referring to. In fact, they're not. So they take that referral fee, and that's how they get the money. So it doesn't matter if you perform well or not to them, because they don't have an ongoing arrangement to them. As long as you keep that loan there, they will be getting the money regardless. Even if you default, or even if you repay that loan eventually, they're still getting their trail coming to them, because when you do a referral arrangement with a mortgage broker, you get an upfront payment, and you also get a trail ongoing payment as well. So this is how they make a lot of their money. And these people who are saying that they've retired before 20 to 30, advertising these sort of schemes, some of them are still working, and some also going on morning TV shows as well. It's got to make you think, is it really the property making the money, or is it selling the property dream making the money? Now you may be thinking, damn, that's a big loophole actually, like a huge, huge loophole. Why hasn't this been, covered up or not? Like, stops from people from doing this. Well, the main thing is this. The loopholes and exceptions are there for very, very good reasons. Can you imagine a real estate agent trying to give property recommendations and requiring an AFSL and become a financial advisor where 95% of information that he has is completely irrelevant to him on whether a property is good or not? Nah, fat chance, unlikely. So there are actually good reasons of why these exceptions are in place. It's just basically people abusing them and giving really poor advice to people who shouldn't even be in the situation of trying to borrow for an extra investment property unless they really have the resources to do so as well. And these sort of advertisements are targeting people in that $80,000 to $100,000 range who have very little investment sense, because they don't know what a good property is. They have very little expertise, and they will get found out. And the people who recommend them the strategy, they won't take any flack for it, because they'll just say they're providing general advice and make them take the onus of it and put responsibility on them. These are how these sorts of people operate. It's all their responsibility when they come in and give you the strategy, but once the strategy is in place and they've got their money, it's on you. And this is how these people operate, okay? When you see one of those advertisements, they don't have an AFSL and they promise ridiculous returns, go see a financial advisor, okay? If you want a reality check or what happens in reality, a financial advisor, or just look at the average return for the last 30 years in the stock market and be like, if anyone's offering at least double of that, it's ridiculous. And it gets more ridiculous. Some of these people even Australian credit licenses where they can mortgage the mortgage for you. You get the full referral from the bank itself. And some of them are even real estate agents where they'll get the kickback if they sell you the property or buy the property on your behalf of the commission. So not only are they getting the organising the mortgage commission, they're also getting the commission on selling the property or buying the property as well if they organise it for you. So they're getting like 5 clips of the ticket while selling you your investment property dream. So they could have easily taken about, most real estate commissions can be between 2 to 3%. And the mortgage commission can be an easy 0.5% on your interest. And they've taken about 3.5% out of your investment property dream before you get into it. And to even return that extra 3.5% they've taken out, you have to get a 7% return just to do that. You don't have to get double the amount. And it's just ludicrous that these people are getting away with it. Because they also say in their own disclaimers is that which is very, very well hidden, by the way. If you need financial advice, go see a financial professional at this organization, which is a defunct organization because they've merged now, which is the AFCA, not AFCA, sorry, the Australian Institute of Financial Planners. They merged together. And I'm just sitting here being like, oh my god, like they're just taking advantage of people who have no idea of financial education or no idea what they're getting into. Anyways, that's pretty much it. If you ever see one of these groups and they don't have an AFSL number, back away, okay? Go see an advisor first. Do not go to any of these groups unless you know exactly what you're getting yourself into.